Hi, everyone. This is Rob Roy, Belly Wave Options, and welcome to the U.S. market update. The markets just closed on Friday, June 2nd, and here's where we close. As you can see, the market did break above that 420 level on the back of the jobs data that came out. So, guys, if you have that link on the jobs report, as you'll be able to see on the link, it came in much better than expected with 339,000 on the non-farm payrolls, only 190,000 were expected. So this, I think, is a little counterintuitive, because if you've been following along, you're like, well, I thought the Fed didn't like a hot jobs market. That was one of their mandates, is they wanted to slow down the jobs market because that was creating inflation, wage inflation. So why is a good jobs market buoying the market to the upside? Well, if you read through the report, you'll see that the wage increase part ticked down a little bit. So it was slightly better by 0.1%, better than, or worse, however you want to view it, than expected. So the viewpoint is this was kind of a Goldilocks jobs report. We added jobs, but yet the wages went down slightly. So if we can stay in that kind of a sweet spot, it's viewed as that's a good thing for the markets. Last weekend, we talked about how beware of a head fake. I'm still a bit concerned about that, as far as this being a head fake with this move to the upside. If we go back and look at the chart on Tuesday, and here's where we were after the close Tuesday. We talked about this Tuesday night in our TradeFinder webinar. And by the way, we do TradeFinder every Tuesday night at 9 p.m. Eastern time. It's free. We talk the markets. We look for trade ideas, and we have a live Q&A at the end. Love to have you join. You can see, put a link here, or you can go to the website at ewotrader.com and sign up free for there. It's a really great community. But on Tuesday night, it was talking about how, all right, we had opened above 420, but closed back down to 420. So the market was clearly waiting on, or at least that was the headlines on the financial networks, of whether or not Congress was going to pass the debt ceiling. I've been saying that I don't think anybody really thought that they might not, and that they'd push it to the 11th hour, which they did. If you go based on Janet Yellen's June 1st is when we need to have this done so that we can pay our bills. So the movement to the upside today, some may say, was on the back of that as well, but I really don't think that really is buoying things. I think it was the jobs report, but can the Fed go through and thread this needle? That's giving them a little bit more credit than I do. And the fact that we've got this little gap up here is a little concerning to me. We don't get a whole lot of gaps on the S&P, being the fact that it's an ETF. We look at the 10-day moving average, and you can see we're a little bit overbought. So at this point, I would watch next week, at the beginning of next week, for one, do we get any follow through on this move, or do we come back down, test 420 here, close that gap, and then we see? That's where the rubber would hit the road, in my opinion, because if the market is poised to go higher, we should hold 420 and then turn and move to the upside from there. But any further movement higher with an already slightly overbought condition with that gap, I think, is suspect. So be careful about chasing this move early in the week, I think, is my point, even if the market does open higher on Monday. Looking at interest rates, because interest rates had ticked down a bit, back to the upside today. So what does this mean? Does this mean that money is coming back out of the bond market and into the equities market? It does seem like a little bit of that today. Maybe some left the bond market on pause because it didn't really have the S&P go down. So the fact that rates were coming down, prices going up, didn't seem to affect the equities market. A little bit of a bounce today to the upside did, though. But if we look at the chart, just basic technicals here, you can see that we are right back at resistance, support resistance at 37. So if we get back above there, what does that mean going forward? You know, the Fed governors all came out this week saying that, pretty much letting us know they're going to pause in June, but the Fed Fund Futures is pricing in 25 basis points and a rate hike in July. There's commentary of, is that going to be the straw that breaks the camel's back for the regional banks? or can we handle it? It's only another 25 basis points, but we still have the Fed fund futures pricing in a rate cut in September. Way back, I was saying that I felt like we're going to go from a rate hike to a rate cut in back-to-back meetings. Now it looks like we're kind of closing in on that could be a possibility. But as far as where rates are, you can see the wave 4 here is at 79%, so that's right at that 78.6% level. Elliott, if he was here, would say, yeah, well, I know that counts as a fib level, but when you see a corrective level like the wave 4 move past 70%, oftentimes that disqualifies the pattern. We'll see if that's how it plays out. I just think we're still right in this trading range, which I do feel is a good spot between 34 and 40. And if rates can stay in here, I don't think they're a positive or a negative for the markets. The market's left to its own devices at that point in time. One last note here on the TNX is that we do have a bit of a zigzag pattern set up here, which could potentially, with this B wave retracement, get us back up to the 40 level or slightly above. That I think would be getting into the area where maybe that starts to negatively affect the market. So that's something to watch for over the coming weeks. That's not something that'll be as early as next week, but just going back to the S&P, again, whether or not we follow through or retrace, that's going to be the key here. The wave 5 is at 73%. When you have a 38.2% wave 4 correction, you're looking for 61.8. So we're a little extended there on the wave 5 also. So looking at some of our other markets, the Dow, we've been between this 330, 340 level for quite some time. No 5-wave pattern labeled on the Dow or the DIA to be specific. We're in this trading range between 330 and 340. Big move to the upside today on the Dow and the DIA. We put the moving averages on. You can see that we tapped the 50-day moving average on the low. But nothing really matters on the DIA until we either break above 340, and this is always with follow through. You have to have a follow through day. So a break above 340 or below 330. Anything in between here, I think, is just status quo, churning, whatever on the DIA. But you have to respect that was a pretty decent move today. Now let's look at the Qs, because this is where the action has been, right? I've been talked about this in TradeFinder as well, that this is reminiscent to me of the .com era back in 1999, where anything that said I or E or .com just immediately got a ridiculous valuation and stocks surged to the upside. And then over time, it worked its way out. I've been asked a lot, was asked during TradeFinder about my thoughts on AI. I think AI is here to stay. But I think it's going to be very similar. I think there's going to be a lot of companies that are getting some extra boost here with AI commentary that are probably going to fall back down. Some companies likely to go out of business, but the leaders, the winners in AI will be strong, and there'll be some accumulation, etc. So I think it's going to be a very similar thing, but be careful on chasing this kind of move. Someone actually asked me, when do I think the AI bubble will pop? And my answer was probably a little bit longer than you think. It takes some time before bubbles pop. And again, then you get the weeding out process of the strong survive and the weak go away. But as far as the Qs, no doubt that all the AI chatter this past week or so has buoyed the Qs to the upside. We're in a wave 3 now, so relabeling to a wave 3 to the upside. You got to pay attention to that. But this last part of the move has been a bit vertical. I don't like that. And then we have this bit of a gap here. So there's separation between where we closed on the Qs and the 10-day moving average. So we're overbought from that standpoint. So a vertical move being overbought, I'd be a little cautious on the Qs at the beginning of the week. A little bit of a pullback, some consolidation, I think, is warranted. The biggest pullback that I think that we could have would just be back to fill this gap and possibly a test at 330, but we might not even make it down that far. When you have a move like this that's this strong and it's in a wave 3, and you can look at the DMI, our favorite confirming indicator to Elliott wave, it's about as strong as it gets. So it's showing you there is legit strength to this move. So much of a give back is probably not in the cards. but I do think some consolidation is warranted with a slight drift lower, but it's not much. I wouldn't consider shorting this or anything. Just I wouldn't chase it right now. I'd let it consolidate a little bit and then let that play out. And if we are indeed moving higher, breaking out of that big, huge triangle in the S&P that we've been talking about for quite some time, then obviously this is going to lead the way once again. But maybe a little caution at the beginning of next week. Here's some news. Finally, something happened out of the Russell. We've been going through this level where we've been in 170 to 190 for so long, and then the range tightened up over the past few months to 170 to 180, and look at that. We broke above 180 today. Now, if you look at the Russell as a risk on, risk off type of thing, small cap stocks, if you will, then you would be putting your faith in the fact that that's showing that there is some appetite for risk. But when we take a look at this, again, there's another gap, and the close, bit of separation from the 10-day moving average, and this move today filled this gap that occurred back in March. So we closed the gap. We're a little bit overbought. We gapped up. Are we going to get follow through from 180 to above 180 on Monday? And can it hold? That's going to be the key. Will it be able to hold moving to the upside from here? You know, that's going to be really interesting to see at the beginning of next week as well. So if we take a look at the VIX, look at that move to the downside. I'm curious as to what everybody thinks here looking at this. What do you think about the VIX? Does the VIX matter anymore? I used to trade the VIX and did extremely well on the VIX. So when they moved it from the OEX to the SPX, covering 500 stocks, it hasn't seemed to work as well. And I don't even trade the VIX. I still look at it. It is a good indication of fear and greed, but it's not a tradable vehicle, I don't think. I know there's a lot of people that pair it with the VXX, et cetera. But it's been difficult for me. I've tried and I haven't been successful trading it. So just keep an eye on it to see what's going on. But it is worth showing. We broke below that level at 17, 18, wherever you wanted to draw your line. And then we had a couple of touches down here at 16 that occurred at the end of April and the middle of May. And we're well below that now. And if we look at the 10-day moving average, you can see we're even separated from the 10-day moving average on the VIX. And I think it's a fair argument to say, well, with all this volatility that's been going on, some of the retail stocks have been crushed. Some of the tech stocks have been rocketing higher. And by the way, we do a live Q&A on stocks every Friday at 2 p.m. over on the Hub channel. So if you go over to the Hub Financial channel on YouTube, register there. You can join us on Friday afternoons at 2 p.m. Eastern time, where we talk individual stocks. And we talked a lot about that today, as far as some of the stocks have been rocketing higher and some of them been shellacked to the downside. But there's volatility regardless whether the stocks were rocketing higher or moving lower. And that is certainly not evident in the VIX. And the VIX is the S&P 500 as a whole. And, you know, it's a stock picker's market. All the more reason to join us live and talk stocks. We take your questions, look at your stocks of interest every Friday afternoon. It's a lot of fun. But I just think that you have to take the VIX almost with a grain of salt, but keep it in the back of your mind. So looking at this move, can we go lower from here? Doesn't seem possible. So perhaps at least a test back up to 16 on the VIX. Maybe that indicates some weakness at the beginning of the week, but that's a pretty vertical move to the downside below areas that have been support. And if you're wondering, is that like an all-time low? We've been down to 12. We've even been lower than that. And that could occur if we get a significant upward follow through and breakout on the S&P. But it doesn't seem like that wants to occur at the beginning of the week with this vertical move lower. We are going to talk about a couple of different international markets. We do cover the international markets in TradeFinder on Tuesday nights. That's what I was telling you about, Tuesday night at 9 p.m. Eastern time. You can register at eotrader.com. We cover a multitude of international markets, just highlighting a couple for this market update. One that we need to look at is India, because that's been powering higher, getting almost to the point where that wave 4 is disqualified. And you can see the multiple zigzags that are occurring here in the India market, one of the best performing markets internationally. But look where we are. We're right at the 100% extension on that original zigzag. It only had a 38, almost a perfect 38.2% B wave correction on that fib level. So that indicates a 61.8% extension, and we bounced down from that. And then you wonder, do you have an extended C wave? And in this case, we did. So the next level is 100%, which is exactly where we are today. So I think you want to be a little cautious here on the INDA, hitting that 100% extension, and also an area that could act as some resistance going back to December and January earlier, but very impressive. And then we'd be remiss if we didn't talk about this complex C wave that has its own zigzag, which could lead us just a little bit higher on the INDA, but you're getting up towards 42 and change. It's still in this area of resistance. So you've got a couple 100% extensions here saying that we're probably bumping our head against some major resistance on the INDA. So you want to keep an eye on that if you've been long, maybe take some gains or tighten up your stops. And then I also wanted to show you Japan, which has been chatted about a lot on the financial networks. And look at this move higher here. We've been talking about this over the last week or so in both TradeFinder and our insiders meeting. And there's a zigzag there, same scenario. So the 38.2% level takes you to 61.8. We hit that, consolidated for a couple days, moved up. Oftentimes you get a test of the previous fib level before the next move. And then look where we are here, right at the 100% extension. So that's the extended C level on the EWJ for Japan. And then again, just like we had with the INDA, we do have a complex C wave, and that would take us potentially a little bit higher here on the EWJ, but same exact scenario on both the INDA and the EWJ. That really nice moves, pretty vertical on the Japan market here. So, I don't like that. We put the moving averages on, separation of the 10-day moving average. So we're getting to an area of resistance here. So what's been working globally is in an area that could bump its head just a little bit. But are we breaking out on the S&P, or is this the head fake that I kind of hinted at last week? It's going to be really interesting to see. So thanks for watching, everybody. Have a great weekend. Promises to be a really interesting start to your week. Take care, everybody.
If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.